Something interesting happened in a conversation that I had with someone recently. And the discussion turned to the market volatility. Stocks going up, stocks going down, interest rates, inflation, the usual concerns that people have. The person I was talking with said something to me that I hear fairly often. They said, "I'm not worried about the market because I have a pension." Now, on the surface, that sounds reasonable. For decades, people have been taught that pensions are safer than 401ks. See, a 401k moves with the stock market. A pension gives you guaranteed income. So psychologically, people think of pensions as stable and protected. But here's the question almost nobody asks. Where does all the money inside those pensions actually get invested? Because pensions don't just sit on a pile of cash waiting to pay out retirees. They have to invest that capital somewhere. And the investments they've been making over the past 15 years have changed dramatically. In fact, a huge portion of pension money today flows into something called private credit. And that's where companies like Apollo and Blue Owl come into the picture. The pension return problem. Let's start with the core problem pensions face. Most pension systems are built around an assumption. They assume that over the long term, they can earn somewhere around 7 to 8% annually on their investments. That assumption isn't random. It's based on decades of historical returns from a mix of stocks and bonds. But the financial environment changed significantly after the global financial crisis. Interest rates fell to extremely low levels for over a decade. Government bonds, which traditionally made up a large portion of pension portfolios, suddenly yielded far less than they used to. In many cases, they were yielding 2 or 3%, and that created a massive gap. If you need to earn 7%, but your safest assets only earn 2 or 3%, something has to change. So pension funds began searching for investments that could generate higher yields. And that search led them deeper into something called alternative assets. What alternative asset managers do? This is where firms like Apollo and Blue Owl come in. These companies are known as alternative asset managers. Their job is to raise capital from large institutional investors, pension funds, insurance companies, sovereign wealth funds, and then deploy that capital into investments that exist outside traditional stock and bond markets. Some of the largest firms in this space include Apollo Global Management, Blue Owl Capital, Ares Management, Blackstone, and Brookfield Asset Management. Instead of buying publicly traded securities, these firms invest in things like infrastructure projects, commercial real estate, private equity acquisitions, and increasingly private credit loans. The pitch to pension funds is simple. These investments can generate higher yields than traditional bonds. And because they aren't traded daily on public markets, they appear less volatile. What private credit actually is. So what exactly is private credit? In simple terms, private credit means loans that are made outside the traditional banking system. Imagine a mid-sized company that needs to borrow money to expand operations. 20 years ago, they probably would have gone to a bank. Today, that same company might borrow from a private credit fund managed by Apollo or Blue Owl. These funds lend billions of dollars to companies across many industries: manufacturing companies, energy companies, technology firms, infrastructure developers. The loans are typically structured with interest rates that are higher than traditional corporate bonds. Often, they are floating rate loans, meaning the interest rate adjusts when central bank rates rise. From a pension fund perspective, this is attractive because instead of earning 3 or 4% on bonds, they may earn 8 to 12% on private credit investments. Why private credit grew so fast? Private credit didn't grow this large by accident. A big part of the reason goes back to what happened after the 2008 financial crisis. After that crisis, regulators forced banks to reduce risky lending activities. Banks had to hold more capital and limit certain types of loans. That created a massive gap in the lending market. Companies still needed financing, but banks were less willing to provide it. Private credit funds stepped into that gap, and over time, they built a massive lending ecosystem. Today, the global private credit market is estimated to be around $1.7 trillion, and a significant portion of the capital behind those loans comes from pension funds. The liquidity issue. Now, here's where things get interesting. Private credit investments are not very liquid. Unlike stocks or bonds that can be sold instantly on an exchange, private loans are long-term contracts. They might last 5 years, 7 years, sometimes even longer. That means the money invested in those loans cannot easily be withdrawn. Because of that, many private credit funds limit when investors can take their money out. Some allow redemptions only once per quarter. Others place caps on how much capital can be withdrawn during any redemption period. If too many investors investors request withdrawals at once, funds can actually restrict redemptions. This isn't unusual in private markets, but it's something most people with pensions never think about. Why rising rates matter? For much of the past decade, private credit performed extremely well. Interest rates were low. Companies could easily refinance debt. The economy was relatively stable, but the financial environment has changed. Interest rates are now significantly higher than they were just a few years ago. And because many private credit loans are floating rate, the cost of servicing that debt has increased for borrowers. That means companies are now facing higher interest expenses than they originally expected. If economic growth slows or refinancing becomes difficult, defaults can start to increase. Why Canada is important. Canadian pension funds are particularly well known for their investments in private markets. Large funds such as Canada Pension Plan Investment Board, Ontario Teachers Pension Plan, Ontario Municipal Employees Retirement System have pioneered what's sometimes called the Canadian pension model. They allocate significant portions of their portfolios to infrastructure, real estate, and private credit. This strategy produced strong returns historically, but it also means these pension systems have substantial exposure to private markets. The domino risk. If economic stress continues long enough, a chain reaction can begin. Corporate borrowers struggle to refinance loans. Private credit funds experience rising defaults. Investors request redemptions. Funds restrict withdrawals. And pension funds eventually have to adjust the value of those assets. None of this happens overnight, but it shows how interconnected the modern financial system has become. Here's my closing message. The takeaway here isn't that pensions are doomed. The takeaway is something much simpler. Modern retirement systems are far more connected to private markets than most people realize. Understanding where capital flows and how those investments work can help you see financial risks long before they appear in headlines. And when it comes to finance, the most important rule is always the same: follow the capital.